rated GE. Content carried in here is suitable for general family viewing.
Hello students, once again welcome to KUTV Elim Live. Today we have a lesson in business studies for Form 3 students. I am your teacher, Mr. Ndenga-Global. Welcome. In our today's lesson, we are going to study the topic we call business transactions. So our subject is business studies for Form 3s, and our topic will be business transactions. Business transactions. Business transactions is the second topic in accounting for high school students that is covered in Form 3, Topic 8. Which has a foundation on the topic we call net worth of a business that we discussed in our previous lesson. So what we shall need to do is to review shortly why and how do we come to business transactions. Then from there on, we will build up to the end of our lesson. But by the end of the lesson, what we need to be able to cover will be, we shall have to have an understanding of one, the definition of business transaction, the definition or the meaning of business transactions. We shall have to know what is business transactions. Number two, we are going to look at the factors that affect changes in capital. And number three, we shall also look at the effects of transactions, on a balance sheet. The effects of transactions on a balance sheet. So those are the three items that we shall discuss in our today's lesson. One, to get to understand the meaning of business transaction. And number two, we shall have to look at the changes in capital. And number three, the effects of change or the effects of transactions to the changes in the balance sheet items. To start off, we need to first understand or make a recap of what is business as we learned in Form 1. In Form 1, under the introduction of business studies, we defined business as an entity which constitute of all activities that this one simply refers to all activities that are carried out by an individual or an organization with the view of making profits. That was the definition of the term business in Form 1, that an activity that is carried out by an individual or an organization, and the main reason for business is to make sure that we achieve the realization of profits. And we said that where there's no profit, then there was no business at all. So these business activities then constitute to what we refer to as business activities, and we gave the types of business activities in Form 1. But thereafter, again, we discuss what we call components of business studies. Students, do we remember the components of business studies as described in Form 1? Yes, there are 5 components of business studies. 1, we have accounting. So the components of business studies, the components of business studies. 1, it's accounting. Yes. 2, we have commerce. 3, yes, we have entrepreneurship. 4, yes, we have economics. And lastly, office practice. Good. The last one is office practice. So these are the 5 components of business studies that we discussed in Form 1 at the introduction stage. And therefore, we are now focusing on business transaction as an element under accounting component. So business transaction is an element under accounting component. Therefore, what we do in business transaction has to oblige to what accounting provides. Therefore, students, what is accounting? What is accounting? Yes, accounting is the systematic accounting. We said that accounting is the systematic way of recording and analyzing business transactions, with the view or simply to aid or to help in decision making. That is for decision making. To aid in decision making. So this is the description of accounting, and it has to be systematic. It has to be in an order, and what we do is we record and we analyze. What do we record and analyze, students? Business transactions. We record and analyze business transactions, and that is where we are today in our lesson, business transactions. So it originates from the introduction of business studies and the concept of accounting, that we then get what is a business transaction. What is a business transaction? Therefore, with that in mind, students, what is this business transactions? We explain business transactions. Business transaction is any dealing between two parties, and these parties have to be in a business terms, between two parties, that can be assigned a monetary value, So if we have any transactions or any deal that is business in nature, and therefore we can assign it a specific monetary value, then that is what we call a business transaction. Therefore, it is monetary in nature. We have to quantify it in monetary terms for us to be able to get to a point of identifying whether we've made a profit or we've not made a profit. So that is the meaning of the word a transaction or a business transaction. For example, if we are to have a case, a very simple case, for example, if we have a deal to do with the exchange of goods, So let's maybe talk about the exchange of goods. And in particular, in this case, I want us to have the exchange which deals with the selling of a product, let's say furniture. We are dealing with the selling of furniture. So you as a customer, when you come to the business, and our business, let's give it the name of the business as XYZ Traders. XYZ Traders. So there is a person in mind. Let's use the name James, that this is our customer. Our customer is James. So when James comes to the business, which is the XY Traders, he has an intention to buy the furniture. Now what we do is there will be an agreement for the trader to sell the furniture. And this exchange of furniture as our product will not come free. There has to be something that will come from James that is if the equivalence value to the furniture obtained. So what James does is that he will be able to make payment for the furniture. And this payment can be quantified in terms of money. So we quantify this in terms of money. Now let's say that our furniture is worth 20,000 shillings. So when James pays 20,000 shillings, then he's going to have furniture. This payment can as well be done in different ways. Let's be able to know that we can make the payment in different ways or different means of payments. Why? Because there are so many of them. We may not only talk of cash payments, but we can also use other means of payment, such as the use of checks, the use of postal orders, the use of money orders, and so on. So if I'm using the money order, it is still part of what we are discussing here, that there is payment made and that payment can be quantified in monetary form. Therefore, this is what we are referring to as a business transaction. It's an example of a business transaction, which is a deal between two parties. And in our case, these parties will be the buyer and the seller. And this deal has to be quantified in monetary terms. So that is the first item, students, that we are discussing, the term business transactions. Then once we are aware of what is business transaction, students, we need to understand what are the types of business transactions. What are the types of business transactions? That this deal, as it happens, there are classes or there are categories of these business transactions. So number 2, what are types of business transactions? Types of business transactions. Types of business transactions. Yes, students, what are the types of business transactions? Yes, there are 2 types of business transactions. What are they? Good. We have cash transactions. Number 1, we have cash transactions. Cash transaction. And number 2, we have what we call credit transactions. Credit transactions. Will help us to understand what are cash transactions, students, because we covered them in Form 1 under the topic Home Trade, and you discuss under the payment we call cash, the type we call the cash transactions. Yes, this is simply a transaction. Cash transaction is a transaction in which payment for the goods and services is done immediately. Payment for the goods and services is done immediately. Therefore, in cash transaction, there is no credit, i.e., no credit. You get the good, you pay for the good immediately. And how do we pay for these goods? So payment here, in cash transaction, payment is done using either cash. What else? We have checks. So cash, we can use checks. What else? Yes, money orders, or postal orders, Therefore, those are the ways in which we can make payment for the goods and services under cash transaction. Now, whether you make a sale and the customer gives you a check, or gives a money order, or gives a postal order or cash, they are still under cash transactions, because in that case, payment for the goods is done immediately. Therefore, what distinguishes this from other aspects is the fact that in cash transactions, payment is done immediately. Good. Number 2, students, let's discuss what is credit transaction. Credit transactions. Yes, we'll try. What are credit transactions? Yes, students, what is a credit transaction? Yes, a credit transaction is simply a transaction. A transaction in which payment for the goods and services is done on a letter stated debt. In this case, what happens is that you don't pay for the goods or services immediately. What happens is, after you've received the products, you are given a certain period of time within which you are expected to make payment for the goods that you've received or for the service that you've received. In this case, credit transaction is also referred to as deferred payments. Credit transaction, students, is also referred to as credit, that is deferred payment, meaning there is the deferral of the terms to be used for paying those products. And as we even continue, students, you'll be able to get to connect the two topics that we are discussing. This is the business transaction and the topic that we discussed in Form 1, home trade, because that is where we get to know the terms of payment and the means of payment. So when you're discussing the means of payment, we are using the cases for cash, the likes of checks, use of money orders and postal orders. And when discussing about the terms of payments, that is now when we talk about the cash and deferred terms of payment. So those are the two types of business transactions, either cash transactions or credit transactions. Good. Again, students, in this topic, when we are discussing business transactions, as we've already explained, that this is a dealing between two parties that have a case or can be able to assign the deal within the monetary system, where we can quantify it in terms of money. And in the previous topic, when we were discussing net worth of a business, we discussed these terms. In our previous topic, we discussed these terms. Number 1, we discussed assets. Number 2, we discussed liabilities. Number 3, we discussed the concept of capital. Number 4, we explained expenses. And number 5, we explained revenues. These are the 5 terms that we discussed in our previous lesson when we are discussing net worth of a business. Now, why do we need to know these terms? It's because at this stage, we are going to engage the third term, which is capital. And when we are discussing these terms again, the first three terms were connected by what we call the bookkeeping equation. So students, what is the bookkeeping equation? What is the bookkeeping equation? Yes, the bookkeeping equation simply provides that assets equal to capital plus liabilities. Capital plus liabilities. That is the bookkeeping equation. It is called the bookkeeping equation. And the bookkeeping equation is also referred to as the accounting equation. Why do we need to understand this bookkeeping equation? It's because in business transactions, we discuss the component we call capital. We discuss capital. So from this view, what is capital? Students, what is capital? As we discussed in our previous lesson, what is capital? Good. Capital simply refers to the owner's claim in the business. The owner's claim in the business. Capital. This one refers to the owner's claim in the business. Owner's claim in the business. What you as the owner of the business claim to be yours, claim to your own possession, is what we call capital. That when I start the business as the owner, there is something that I will inject into the business which gives this business a life. What I inject in my business is what we call capital. This capital is also referred to as, so capital is also referred to as owner's equity. Owner's equity. Capital is also referred to as owner's equity. What is your equity? What is your claim from the business? And it's important, students, again, you remember that the owner's equity does not necessarily mean cash, but it also has to do with assets. It has to do with resources. And that is why when we are giving the concept of assets, it's all about capital and liabilities, meaning capital also has something to do with the assets. For example, if I want to start a business, let's talk of example of a simple business like a cyber business, providing maybe the internet services and the printing and typing and such. I may start by having a computer that has been donated from a friend. Because again, you know, the sources of capital is not only about your own contribution, but also comes out of donations. So if a friend donates to you a computer to start the business, now that forms part of your initial capital. Therefore, when talking about capital, do not only look at it in terms of cash, but also look at it in terms of the resources that you inject into your business that gives you the opportunity to be the owner and therefore giving your business the life for it to exist. And therefore, if this is capital and the sense in which we start businesses is to be able to make profits. But again, there are two things that must exist when you start a business. Number one, we must have what we call the business growth. And number two, we must attain business survival. That your business has to grow and it has to survive. When we are discussing growth of a business, we are looking at it in terms of the sales volume. How much are you selling in a day or within a given period of time? your sales volume. When discussing about survival, how well can you compete with other businesses? Because competition is part of business. You will do a business maybe in region A, and there is another business in the same region providing the same product. So you as the business owner, how do you survive? How do you sustain the competition and become the best such entrepreneur or the best such owner of a particular business? It is based on how you're going to manage what we call the factors of production. And therefore, capital has to rise. When you start a business, it has to keep on rising for us to be able to say that your business is doing well. If you start a business, for example, you start the business, and let's say with a capital, you start a business with a capital of 100,000 shillings. In your business plan, there has to be a component that will give us a prediction of what we expect within a specified period of time, and usually within 1 year. So you'll say, I'm starting at 100,000. After 1 year, I need my business to be at a level of a capital base of 300,000. So your expected projection will be, rise will be maybe say 300,000. So the question is, how do you attain this change from 100,000 to 300,000? Or let's say maybe you start with a small business worth 20,000 and say after 1 year, my business should have a capital base of, let's say, 50,000. What will constitute to this change in capital from 20 to 50? Or from 100 to 300, or from even 10 to 20, whichever figure that you have, as long as there is a rise in the business capital. Again, the same factors can also be brought in terms of reducing the capital, because business success is not automatic. It comes as a result of your investment and your managerial skills that will bring to a business success. Therefore, as much as we are projecting a rise, we can also have a decline in the capital base. So those are the things that we want us to discuss in our next subtopic. So we'll discuss changes in capital, and in particular, factors that result into the change in capital. Factors affecting changes in capital. Factors affecting changes in capital. And these changes, we are saying it's either an increase or a decrease. So again, students, we shared these factors in our previous topic. So we'll remind us what are the factors that affect the changes in capital. Yes, we said there are 4. So how many do we remember? Good. 1 is profits. Number 1 is profit. One of the factors that will result into the change in capital is profit. What is profit? What is profit? Yes, profits are gains that we make after a product is sold more than the cost it was acquired at. If we acquired a product at, let's say, 20 shillings, that becomes what we call the cost price. And we sell this product, when you sell this product at 70 shillings, there is some extra income that has been generated out of this. What is that? Our selling price less the cost price is 70 less 20, giving us how much? 50 shillings. Therefore, the 50 shillings is what we are calling the profit. Good. That's what you are calling profit. Therefore, profits are gains that are made when a product is sold more than the cost price. And therefore, this profit has an effect to capital by it increases capital. So profit increases capital. Good. So how will we then achieve the capital at the end? So the capital, final capital, or the new capital, so we'll have our new capital equal to, we take the initial capital, we add profits. Therefore, profits will be able to make an increase in capital. And that could be the case as to why maybe you'll move from 100 to 300. There is a rise out of the profits that have been made. Good. The second factor that affects capital. Good. Where there are profits, then there is also a possibility for the losses. Number 2, losses. Losses happens when we sell less than the cost price. So if the cost price, for example, cost price was 100, and we sell, let's say 70, then there is a difference, but a negative difference of 30. So in this case, we obtain what we call loss, will be now the cost price less the selling price, and that is 100 less 70, which is 30. Therefore, when the selling price is less than the cost price, students, what we attain is a loss. Later on, when we shall be discussing more about losses, losses are part of expenses. They are part of expenses. So in this case, losses have an effect of, they decrease capital. Therefore, students, the new capital will be the initial capital. We subtract losses. So those are what we call losses, and the second factor that affects the change in capital. The third factor, students, what's the third factor that affects the changes in capital? Yes, we have what we call drawings. Number 3, drawings. What are drawings? Yes, drawings is either cash. This is either cash or resources taken from the business by the owner to meet personal obligations. You take this to meet personal obligations. What is not business in nature? There are those things that you are going to do using the business resources that is not business in nature. For example, if you take resources from the business for your personal use, that is drawings. Or you take resources from the business like cash to meet your personal needs like entertainment, that is a drawing. Therefore, drawings are resources or cash that is taken from the business by the business owner to meet his or her personal obligations. And so, if they are taken out of the business, students, the effect is that they reduce capital. Drawings reduce capital. Therefore, if I want to attain the new capital, what I will do is I will have to take the initial capital, then I subtract the drawings. That is how I will attain the new capital. Take the initial capital minus the drawings. If, for example, you started a business with 200, let's say your business had a capital base of 200, and you make drawings of 50. You make drawings of 50. Then the new capital will be 200 less 50, which is 150 shillings. Therefore, drawing students, they have an effect of reducing capital. Factor number 4, students, is called additional investment. Additional investment. Additional investment. Additional investments. What are additional investments, students? Yes, as just the word says, additional investment, it means you are making more and more investment. You are pumping in more resources into your business. Therefore, these are resources. These are simply resources. They are resources or cash brought into the business, by the business owner from his or her personal sources. His or her personal sources. Your personal sources. Sources that are not within the frame of the business. When you bring it outside, from outside, to add into what you have in the business, those are called additional investment. Therefore, they go like opposite of the drawings. Drawings you take out of the business, while additional investment you bring into the business. And therefore, they have an effect of increasing capital. So they increase capital. They increase capital. Again, students, how do we then attain the new capital? The new capital then will be, we take the initial capital, we add additional investment. These are the factors that affect changes in capital. There are 4 factors, students. 1, profits, losses, additional investments, and drawings. And we've discussed the meaning of each of the factor and how it affects capital. Good. Let's then bring in the formula that will now help us to determine the closing capital. Because we said businesses have to keep records and they have to analyze those records within a specific period of time that we call the accounting period or the trading period. In some businesses, this period varies. Some will do it after 1 month, some do it after 1 week, some do it after 1 year, and in most cases, that is what happens after 1 year. That we are able to ascertain what is the status of our business in terms of the capital base, the asset ratio versus the liability ratio within the business. So we have to then to look at the capital at the end. At the end means when we are closing, what is the capital at that particular time? And the initial capital is the amount of capital that is at the beginning of the business. Therefore, this is what we shall conclude in terms of determination of capital at the end, what we also call closing capital. We obtain the closing capital by taking the initial capital, also referred to as the opening capital. We add profits if there are any profits made. We add additional investments. We add additional investments and subtract drawings if there are drawings. or losses, if there are losses. That is the formula for attaining the closing capital, or the capital at the end of the trading period. We take the initial capital plus the profits plus additional investment, and we minus losses. We minus losses. So this is the conclusion of that formula, and we can use therefore an example to illustrate this concept and see how do we calculate this capital at the end and at the beginning. So the following balances were extracted from the books of Kimuna Stores. The following balances were extracted from the books of Kimuna Stores. The following balances were extracted from the books of Kimuna Stores. And these are the balances. So the first one is capital into bracket 1/1/2015, 1/1/2015, that is 300,000. With additional investment worth 50,000. With profits worth 70,000. With profits worth 70,000. And then we have drawings recorded as 10,000. We have what we call debtors recorded as 17,000. And the question is required determine Kimuna Stores capital as at 31st December 2015. Determine Kimuna Stores capital as at 31st December 2015. So this is the business for Kimuna, and the records given shows capital on 1st of January 2015, which was 300,000, additional investments of 50,000, profits of 70,000, drawings of 10,000, and debtors of 17,000. And you are told to determine the capital as at 31st December 2015. So what do we do, students? First, we have to identify whether it is closing or opening capital. But in this case, we're looking at the dates, 31st December, that is the closing capital, because 31st December is at the end. This is now the opening capital. So we shall then conclude and say we are determining the closing capital, and the closing capital equal to the initial capital plus additional investment plus profit less drawings. What is our capital? 300,000. So 300,000. What is the additional investments? 50,000. 50,000. Do you have any profits? Yes, 70,000. Any drawings? Yes, of 10,000. And where do we now record the assets, the datas? These are part of assets which are not in the formula. So this one will not be used in our calculations. So students, let's do the calculations now. 300 plus 50 is 350, plus 70 is 410, 420, minus 10, that is 410,000. 10,000. For 10,000, and that is the closing capital. That is the closing capital. So that's how we identify the closing capital at the end of the trading period, given the other factors that affect capital, which we originate them from what we have as drawings, profits, losses, and additional investments. In our last discussion, students, I want us to take a short review of the effects of changes in either capital or liabilities based with the transactions and how they affect a balance sheet. What is a balance sheet, students? Yes, this is simply a financial statement that shows the financial position of a business as at a particular time. So if we are preparing it as at 30th June of any year, then that becomes the record of the financial position for that particular year as at that date. A balance sheet, students, is prepared mainly to confirm the accuracy of the bookkeeping equation. We prepare the balance sheet to confirm the accuracy of the bookkeeping equation, which has asset is capital plus liabilities. And that is why the preparation of the balance sheet has or adopts this format, the format of a balance sheet. It adopts this format. One, we said that the balance sheet must have a heading, and the heading has three things. One, the name of the business. It must have the name of the business, the name of the business. Below the name of the business, we write the name of the statement, which is balance sheet. Balance sheet. And below the balance sheet, we write the date as when the balance sheet is prepared. So let's say as at. Then we give the date, the month, and the year. We give the date, the month, and the year. And the statement is prepared in a T format. We prepare the balance sheet in a T format with two sides, the left side and the right side. How do we call the left side of the balance sheet, students? Yes, we call this side the debit side. So we use the DR. And how do you call this, the right side? Yes, it is called the credit side. So we use the CR. In a balance sheet, we record transactions based on the left side, we capture the information relating to assets. The right side, we capture the information relating to capital and to liabilities. So we start with the fixed assets. Fixed assets. We capture the list of fixed assets. And there are very many fixed assets we may have. Let's say example of furniture. Furniture, for example, land, etc. Then below the fixed expenses assets, we write now current assets. Current assets. Again, we give the records of current assets. Examples, for example, debtors, stock. We can talk of stock, we can talk of cash in hand. Cash in hand. Again, we can talk of cash at bank, and so on. Then get the total for each one of this side. Each of this side, and so we get the total here. On the credit side as well, we have the record now for capital. So we start with capital. And we've given how to adjust capital. Therefore, if you find there is profit, we shall add profit. If we find we have additional investment, we shall add. If there are losses, we subtract. If there are drawings, we subtract. So we make sure we do the adjustment to capital. And below it, we now record liabilities. with long-term liabilities, we give the record of long-term liabilities. For example, we can talk of the 10-year bank loan, and then we give short-term liabilities. There are many short-term liabilities. You can give an example of the creditors and the bank overdraft. So the sum of this gives us the total. And the totals on the debit side and the credit sides will always be the same. And make sure when you're closing the statement, you underscore the totals. You write the two horizontal lines to mean that you've closed the statement at that particular point, and therefore the balance are equal. And so in this class, therefore, under business transactions, students ought to understand that we'll have a case whereby we are given a balance sheet to make adjustments. So we have to know how to interpret statements to make now adjustment to the balance sheet. And that is now our question that we shall end up with. So we can be able to have the question. Yes, so that is a question that we have to show how the effects of transaction on the balance sheet totals. And you're told that the following balances were extracted from the books of Mwakideu traders as on 1st January 2017. So those balances relate to Mwakideu traders with the balance for capital, which is 600,000, with the balance for creditors, 100,000, with the balance for motor van, 200,000, with furniture, 200,000, stock, 60,000, debtors, 80,000, cash, 240,000. So those are the balances for Mwakideu. But then within that year, there's something that happened again. So the following then transactions took place during the year that ended 31st December 2017. The first thing that Mwakideu traders did, they sold furniture worth 40,000, cash, sorry, worth 40,000. That is cash was received, and then balance was due to at the end of the year. Now, something missing there. Sold furniture worth 60,000. Sold furniture worth 60,000, and 40,000 cash was received. 40,000 cash was received. Then number two, purchased goods worth 100,000, for which cash of 70,000 was paid, and the balance was still outstanding at the end of the year. And the third case was that cash of 10,000 was taken from the business by the proprietor to settle the spouse hospital bill. And you are required to outline the effects of each transaction on the items of the balance sheet. And that is 8 marks. So that is what we want to analyze in our lesson and see how do we account for those transactions. So we'll start by getting to know the balances. And as outlined, the balances were capital. We balance for capital. Balance for capital, which is 600,000. 600,000. Then the business had a balance of the creditors. We had creditors worth 180,000. Then we have motor van, which is worth 200,000. furniture worth 200,000. And then we have stock 60,000. Stock 60,000. Debtors 80,000. And then we have cash 240,000. So just very fast, students. The first transaction, so if you could have it now on the screen, the first transaction which was done was that there was sale of furniture that was worth 60,000. And so when we sell furniture, what happens is that we reduce the furniture. So we reduce the furniture by 60,000. We reduce this one by 60,000. And then the sale of furniture, 40,000 was received in cash. So we go to cash, we add 40,000. Add 40,000. And then the balance, which is how much? 10,000, because we sold. So the 10,000 balance that was not received goes to the value for the debtors. So we go to the debtors, we add 10,000. We add 10,000. Second transaction. Yes. Purchase goods worth 100,000. Purchase goods worth 100,000, for which cash 70,000 was paid and the balance was still outstanding. So purchase, when we purchase goods, we have a rise in stock. So we go to stock, we add 100,000. 100,000. So this is 20. We add 100,000. And then when we purchased the goods, 70,000 was paid and the balance was still outstanding. So we pay 70,000, meaning now the 70,000 will now be subtracted from the cash. So we subtract 70,000 that we are using to pay. And then the remaining balance, that is 100 minus 70, makes it 30. So that goes to creditors. So we add 30,000 on creditors. We add 30,000 on creditors. And then lastly, number 3, we have been given that cash 10,000 was taken from the business by the proprietor to settle the spouse hospital bill, meaning those are drawings. We are settling the spouse hospital bill, that is 10,000, and drawings reduces capital. Again, we are taking in terms of cash, so we reduce 10,000. So those are the effects. So the total of capital will be, now we shall have 600 minus 10, 590,000. 590,000. This is 210,000. This remains 200,000. 100 minus 60, this is 140 for furniture. Stock rises by 10, so that is 70,000. Debtors rise by 20, that's 100,000. And cash, 240 plus 40 is 280, minus 80,000 is 200,000. So if you could project for the last time, those are the figures that we have, and we are now told to prepare. We are told to prepare the balance sheets. So after we've done the effects, which we've already shown, now we need to show the balance sheet. So we can now finally quickly look at the balance sheet. Just draw the balance sheet totals that we have. So we'll write the name of the business is Mwakideu. So Mwakideu Traders. Then balance sheet. Balance sheet as at 31st December 2015. Then have this statement here. This is CR, this is DR. And then for the DR side, we start with fixed assets. We start with the fixed assets. Fixed assets. And our fixed assets here, we have two. We have motor van and furniture. So motor van, Total of motor van is 200,000. We have furniture worth 140,000. Then we have current assets. In our case, for current assets, we have a stock worth 70,000. Stock worth 70,000. We have debtors worth 100,000. And then we have cash worth 200,000. Cash worth 200,000. So we have cash. The value for stock, we had 60 plus, this is 160. 160, sorry for this. This is 1,600 plus 60, it's 160,000. 160,000. And then on the CR side, students, now we start with capital. So because of time, we shall write capital, which is now 590,000. And then we have liabilities. So we have liabilities, in this case, which are short-term liabilities. We have creditors worth 210,000. Yes, we have creditors worth 210,000. So let's see the totals on both sides. 210 plus 590. 210 plus 590. That gives us 800,000. On this side, 200 plus 140, 340. 400, 500, 600, 800. So the totals have balanced. So our balance sheet has the same totals on the DR side and the CR side. And that is how we can make adjustments to the items in the balance sheet by using the changes created by transactions that have been given as we had in our sample question. So that is the revision that we can have for the business transactions. We've discussed about the meaning of business transactions, discussed what are the types of business transactions. We've also discussed the factors that affect changes in capital. And finally, we've looked at the effects of transactions on the balance sheet items. That is the end of our lesson for today. I've been your teacher, Mr. Ndenga-Global. Until next time, goodbye.